podcast. I'm Ruveyda Gozen, a research economist at the London School of Economics. And normally here you would hear John van Reenen speaking and introducing himself, but due to his new role in the current UK government, congrats to the government, by the way, for having him and Anna Valero, actually. He won't be able to participate in the second season, but I'll be here as in the first season, and I may have surprise guest co-hosts throughout, so stay tuned. And in this season, we continue to have impressive researchers, and today we have Sabrina Howell from NYU Stern. Welcome, Sabrina. How are you doing?
I'm good. Thank you so much for having me.
It's so great to have you. And let me introduce you to our audience as well. So, Sabrina Howell is a professor of finance at the NYU Stern School of Business, and she's also a faculty research fellow at the NBR and a research fellow at the Private Equity Research Consortium. And her research focuses on entrepreneurship, private equity, fintech, innovation, energy, and China. And today we will talk an important aspect of innovation, I think, which is something that we did not touch upon in the first season, and that is the financing of innovation. And we will talk about venture capitalists, fintechs, the role of government subsidies and grants, and more. But before we go into the research questions, I want to, I asked this question to all of our guests because I wonder their stories. So I want to ask you first, what made you interested in these areas? Was there someone, like maybe a family member or someone from the university, a faculty member, professor, or something, an event that influenced you to, choose this path?
I feel incredibly lucky to have my job and to have landed, in what I think are just fascinating areas for research. So I kind of stumbled upon it after studying Chinese history and the Chinese language in college and having an interest in energy security policy. I started my PhD actually not wanting to be an academic, but rather wanting to work sort of on energy business and policy, and with this sort of background and rigor of a kind of PhD behind me. And to be perfectly honest, I was in part motivated by the fact that the PhD was free, in contrast to alternatives I was considering, like an MBA or a Master's of Public Policy. And I thought it would give me flexibility. So,
Mm-hmm.
but then I started, and over the first few years, wound up kind of drinking the Kool-Aid. I went through the sort of hazing process of the Harvard, the first year of the Harvard economic sequence, and ultimately decided to sort of try out the academic job market. And in that process, realized that the work itself, the collegial environment, the seminar style of receiving feedback and sharing your work just suited me really well, and that it would be like winning the lottery to be able to pursue this career. So I've been really lucky to be able to have done so.
Which is interesting because you were not thinking of academia first and then you changed your mind. And I think that is the atmosphere of academia itself that influenced you the most.
I think the combination of the ability to be curious and ask different questions, to be kind of entrepreneurial. So I study entrepreneurship in much of my research, and I think academia is very entrepreneurial. And so I think this combination of being able to pursue one's own interests, work hard on one's own, but then also be able to engage with great co-authors and great colleagues. It was just a really nice, atmosphere, as you put it. And I think it was just a really good fit with me.
And to also make it more tangible, what do you think you've done differently during your undergrad or PhD that led you to such a successful career in academia? I mean, being in academia by itself is hard, but like you're a professor at one of the top schools. So, what do you think you've done differently?
How it felt in the moment was a very zigzag path. My mom likes to tell me to follow my nose, to just do what is you're passionate about and interested in, kind of in the moment, and not worry too much about the long term. And I think I more or less have done that. And by sort of following my passions and interests, I was able to become kind of an expert on something that I think is important for policy and for the. So I think I've made many mistakes, and I'd be happy to dive into some of them. But I think that sort of um, commitment to focusing on what I'm interested in and working hard at it and developing a certain set of expertise and skills, has been rewarding kind of over the longer term.
Yeah, I think what your mom said, like follow your nose, reminded me Gandalf saying follow your nose, to find a way out. So
Oh, is that from Lord of the Rings?
I think so. Yeah, yeah, yeah. That's what yeah,
Okay.
that reminded me of that quote. Yeah.
Well,
So
I don't know where she got it, but I am certain it is not from Lord of the Rings because I don't think she's ever read them or seen the movie.
I
Um,
got it. And also, since you're a professor of finance, I want to ask another question that I really wonder. I mean, I'm sure you've seen many documentaries or movies, for example, about financial markets or the financial industry itself. And movies, for example, often portray the financial markets, as very aggressive, competitive, very masculine, network based and sexist environments. What do you think about this? Like, is this like a common misconception, or does it hold some truth?
I think it probably has some truth to it. The one, it's not really a movie or documentary, but rather a TV series that I would recommend is Silicon Valley, which I think was on HBO, now Max. And that captures how venture capital works pretty accurately and is also a lot of fun.
Noted. I'm going to take a look at that. I think I did watch that one. Thank you. So let's go into some of the research questions a bit. So the financial markets have evolved considerably over time, and we see bond markets emerging historically, the establishment of central banks and introduction of fiat money, and then gold standard and other kinds of institutions over time. So today, we want to focus on the aspects of financial like financial tools and innovation. So let's say, for example, I'm an inventor or I have a very innovative idea, but I lack the necessary financial means or liquidity to bring it to life. So I need someone to invest in me, but from the investor's perspective as well, it's a very risky move because they don't know if my idea will be a huge success or not. So there is that kind of risk element involved in the both the production of innovation and at the same time from the investor side and investment in innovation. And there are several concepts, and let's define those concepts for our audience first. So since we will be talking about financing, there is something called equity financing and debt financing. And these are, I think we can call them like umbrella terms. Is it possible to briefly explain these two different, financing methods briefly? And then we can go into like private equity and public equity and venture capitalists as well.
These are the two main instruments through which we finance firms. And equity claim is a claim on the future cash flows of a company. It represents ownership and it is riskier and last in line to be repaid if the firm fails. In
Hmm.
contrast, debt typically first in line to be repaid, so it's less risky, but it has a capped upside. So if you finance a firm with debt, the creditor who's providing the debt is going to receive their money back, which we call the face value of the debt, plus some interest, and that's limited. So we could think about debt as kind of a little bit more focused on protecting the downside, focused on mitigating risk, whereas equity is focused on the upside.
Hmm. And how about if I think today we're going to focus on equity financing a bit. So there is something called private equity and public equity. So what are the differences between these two notions?
Right. So public equity is, and we may talk about, public support for innovation. And so these are, it's, I think, useful to distinguish between the two terms. So in this case, public means traded on a stock exchange, available for any investor to purchase a share of ownership. Whereas when we think about, for example, public support for innovation, we're going to be thinking about public in the sense of government. But so public firms have their ownership shares traded on a stock exchange. Those shares are liquid, which means they're really easy for anyone to buy and sell. And for example, a retail investor like you or I can go and buy, Apple stock or any other publicly traded firm. Private firm stock is less liquid, is not available for sale by any retail investor. And there are a lot of regulations and disclosure requirements that apply to public firms that don't apply to private firms. As a result, that essentially emerged out of the 1929 crash and subsequent depression. So there are a series of rules requiring public firms to do all kinds of registering and disclosure in order to protect those retail investors who have sort of the free ability to buy and sell their shares. So in order to protect them from frauds and scams and misleading information, public firms have to do a lot more disclosure, while private firms generally have their stock held by either the owners directly. So you can think about like a restaurant owner is where the restaurant is just a private firm and he owns, let's say, 100% of that firm. So he obviously is sort of knows about the quality of the firm. And then you might have, other investors, you might have employees, wealthy individuals who come in to buy equity in private firms, and they are going to be more actively involved in understanding, or we say doing due diligence on the quality of the firm, and be sophisticated enough to sort of put their money at risk. And so I think the key distinction here is that the investors in public firms tend to be what's called arm's length, that is like far away from the firm, whereas the investors in private firms are closer, have more privileged access, and tend to be more sophisticated and wealthier.
Mm-hmm. So in that sense, I mean, so there are different types of finance, like financing, but like there is, you might be a startup, or I mean, over time, you can grow and then you can become like a big company. Is there an order which one to follow? Like, for example, maybe I should start with, I don't know, like private equity and then like public equity, or like maybe I would prefer traditional financing first, like through banking. Is there like a life cycle decision in terms of these financing methodologies?
Yeah, so particularly thinking about the context here of this being a podcast about innovation, I think it might be useful to set the stage for the role of finance by grounding it in the life cycle, as you said, of innovation. And we'll see that different financial instruments are appropriate for different phases. So, first, innovation begins with an initial invention grounded in basic research that searches for new knowledge with no practical application in mind. So, that's how we think of basic research, like what a physicist might do at a university. The next step is to innovate a use for the idea, to develop and demonstrate a technology. And then finally, there's diffusion, where the new product is sort of commercialized or deployed in the economy. And as new technology moves from this invention to the diffusion stage, the sources of funding shift from government and university at the earliest stages to private capital markets at that initial development and demonstration, and then ultimately, traditionally, to public markets at the final mature stages of deployment, though that is to some degree changing. So private equity and especially venture capital help to fill a gap. And I can tell you a bit about the history of VC, which I recently was working on for a case I wrote with my old advisor at Harvard Business School about innovation financing. But before I get to that history, I think it's helpful to kind of explain the gap. And this is particularly where financial economics is useful, and where I've focused some of my research. So we think that there are frictions or market failures that prevent projects that are sort of outside of large incumbent firms, but that have positive net present values, or NPVs, so they're privately profitable to pursue, but nonetheless don't receive adequate funding. So one friction comes from uncertainty. So innovation projects are uncertain in the sense of having no known variance, no standard deviation. And that makes it really difficult to estimate future cash flows and gauge risk. That means that, for example, a potential debt investor, creditor, would struggle to finance these kind of projects. The outcome probability distributions are fat-tailed. So, for example, among high growth startups that are receiving early stage funding, only a tiny fraction are going to generate large returns, while most will be written off. So, without this is why we need equity financing. Unless the project has assets to pledge as collateral, they're really going to be, potential creditors or debt investors are going to be unwilling to accept the downside with no potential upside. A second important challenge is asymmetric information, which occurs when an agent knows more about the quality of his project than the principal does. So, for example, a startup entrepreneur has more information about her project than does a prospective venture capitalist who's interested in financing her. So this gives rise to a third problem, which is that research can't be completely contracted on ex ante. So it's difficult to set up incentive systems that are going to align the interests of the financier and the agent. And so this challenge of financing that sort of early stage of commercial innovation is really where we need venture capital. And so with that kind of conceptual grounding, we can introduce how it came to be. Does that make sense before I jump forward?
Yeah, yeah. And I think you were going to give an example about the historical, about a historical example of VCs. Would you like to continue with
Yeah,
that?
yeah. So before World War II, there were basically independent investors and big firms. And occasionally wealthy families would fund young companies. But during World War II, there was a proliferation of new technologies that were really developed as part of the war effort. And a Harvard Business School professor named Georges Doriot, together with the president of the Federal Reserve Bank, decided that they wanted to try to find a way to systematically bring these World War II technologies sort of developed for defense applications to the private market. And they created the American Research and Development Corporation, or ARD. And that was really the first VC firm in the sense of financing potentially high growth startups. But it was a publicly traded fund. And so you could actually buy and sell shares in it like stocks. But the problem was that these public market investors, who, as I said earlier, were sort of arm's length and interested in perhaps buying and selling in relatively short time frames, they couldn't really understand the business model or commit to the long time frame that they needed to ultimately get profits from these very early stage investments. And so the VC model, as it more or less exists today, was created when William Draper, who was actually one of Doriot's students at HBS, and some collaborators, including his father, who was a senior government official working on defense, created the very first VC fund in 1958, using the limited partnership as an organizational form. So that was an important innovation, was to create a limited partnership. And together, Draper, along with two other men, established the first such VC fund. And what they did was to solve the long time horizon problem with a fund structure that had a 10-year lifetime, with the idea that investors would put money up at the beginning of the fund, and the managers would then return those invested funds as well as capital gains over the next 10 years. And then after that, this fund vehicle would be dissolved. And with this structure, you had limited partners, or LPs, provide capital to the general partner, who's the venture capitalist, and he's that general partner, or GP, is going to make and manage the fund's investments. And so this was pretty successful, this first fund. And in the early to mid 1970s, a bunch of what are still the top VC firms like Kleiner Perkins, Sequoia, NEA were established following Draper's model. But the industry was still really small. It was super niche. What allowed it to get big was a change in regulation. In 1979, the Department of Labor permitted pension fund managers to invest in high risk assets like VC funds. And that led to a large influx of funds. So pension funds were really the kind of cornerstone investors in VC. They enabled the VC market to develop. And many of these investments that were made in the 1980s were, just some of the most important ones historically. Firms like Microsoft, Cisco Systems, and Apple were VC funded in that period. So what we ended up with was a VC industry that is purpose built to finance innovation with equity investments. The VCs are able to overcome the information asymmetry because they do this deep, close range due diligence and monitor the company afterward, and are closely involved in governing it. For example, having an investor sit on the board of the startup. And the fund structures are able to accommodate that high degree of uncertainty because they have a portfolio which is designed to have a small fraction of investments deliver huge profits. So, for example, if they make 15 or 20 investments in startups, have just one or two deliver huge profits, while the rest are, pretty much failing. And if that happens, the fund can ultimately deliver good returns to investors.
Thank you very much. I mean, I think maybe we could do another episode where we would talk about all the details, like how historically, VCs have changed and how they contributed over time. But then, so can we say that the existence of venture capitalists positively affected the growth of entrepreneurial and innovative activities. And I think, is that a right statement, based on your explanation?
Yes, there's broad agreement that VC has been an enormous innovation engine over the past
Hmm.
few decades. Only, a tiny fraction, about 0.5% of new firms get VC, but those firms go on to have really big impacts on job creation and innovation.
Hmm.
There's a rich literature, showing that receiving VC has large positive impacts on the recipient firms and even on local economic growth. A couple other stats are that, among all the IPOs, basically over the last 30, 40 years, about half were VC backed. And among public companies that have gone public, after the early 90s, VC backed firms account for more than 75% of market value and more than 90% of R&D spending. So basically,
Oh,
if you
wow.
take out kind of the old, really established firms like a ExxonMobil or a GE, that have been around since before the 1990s, essentially all of the new R&D and market value is VC backed. Um, and and we know that not only are VCs firms selecting potentially high growth companies to fund, but they're also actually have what we would say is a treatment effect. So they're improving their innovation capacity and ability to grow through a bunch of channels, ranging from advice, their networks, a certification or signaling mechanism. There's many different channels, but we do think they have a pretty strong treatment effect.
Yeah, and I think you touched upon very important topics that I also wanted to ask. I mean, it looks like, they also help with management and signaling and, network effects as well. So maybe one question is, do you think everyone has like a similar access to VCs?
Well, it's also very well established at this point in the literature in entrepreneurial finance that this group of VC investors, or we could even call them gatekeepers to innovation deployment, are overwhelmingly white, male, and graduates of elite schools, and usually all of the above. There's some important work by Paul Gompers and Sophie Calder-Wang showing, I believe that over 90% of VCs are male, for example, and work by my co-author Emmanuel Yamfor and others have shown that less than 2% are Black. So these are, very, very large disparities relative to population averages. And we might, have equity concerns about that, and access to this very lucrative industry. But I think from an economic perspective, the composition of GPs affects which innovations get funded and move forward in the economy. And if there are increasing concentration of fundraising at a few prestigious VC firms and a very narrow pool of financiers, we may worry that there are actually like good ideas that that are sort of not moving forward in the economy because they don't have access to these investment ideas. And the reason we especially worry about that in VC is because we believe that information asymmetry that I talked about earlier leads VC investors to rely really heavily on personal networks when they're sourcing deals. And reliance on sort of these trusted referrals and personal networks, like from where went to school, may privilege sort of those who are better connected to investors, creating inefficient capital allocation if we think that network-based access to investment opportunities is not perfectly correlated with the quality of ideas. I study that friction specifically in a paper with Ramanananda about networking frictions in venture capital and the implications for the gender gap in entrepreneurship, actually, where to try to understand why women are such a small share of VC-backed entrepreneurs. And it's really difficult to study the role of networks in finance, especially for private firms. So what we do is actually employ exogenous variation in exposure to VC networks through random assignment of judges to panels at a large new venture competition that occurs every year at HBS. And we show that random exposure to VC investors increases the chances of VC backed entrepreneurship for men, but not for women. And this effect occurs through indirect networking channels where actually women are less likely to reach out to judges following the competition. And this sort of helps to explain why the gender gap in high growth entrepreneurship originates like very early in the startup life cycle. at or kind of near the moment of founding. So I think the short answer to your question is sort of no, it doesn't seem like everyone has similar access to VC. Very nuanced and complex reasons, and that does probably have implications for the technologies that we ultimately see deployed in the
Mhm.
market.
And based on that paper, why, for example, female students or women relative, like they reach out to these people less than male students? I mean, is there a specific reason?
We can only speculate about that. I think there
Hmm.
may be, expectations of bias or discrimination. I think there's also a difference in the degree of that and by the way we try to suss out some of these channels through a survey, but it's obviously imperfect. There's sort of less confidence and less belief among the women entrepreneurs that they should sort of reach out proactively. They sort of think that if their idea is high quality, they would basically receive, attention from VCs. And if they don't, it means that their idea is not high quality enough. Whereas the men seem to sort of think that, they don't they sort of start from the presumption that their idea is high quality, and it's just sort of a question putting it in front of investors. So I think there's sort of this interplay between kind of potentially expectations of bias and homophily, where people, like most of the VCs are male and women feel less comfortable reaching out to a male VC than a female VC, and then finally sort of differences in confidence and expectations.
Hmm. And also, like, since we're talking about these gender differences, maybe we can change the scope a bit. So we can, because if you look at like developing economies, I remember that, there were papers, especially like looking at like microfinance and how it affects entrepreneurship. So I mean, financial restrictions is an important concern for entrepreneurs. And do you think financial technologies or fintechs going to help solve that problem?
So fintech is like a catch-all term for technologies or startups that are trying to disrupt financial services by bringing innovation like digital and information technologies and big data, to financial services. And we typically talk about fintechs as in the context of sort of startups, usually VC-backed startups, that are sort of bringing these new technologies and better user experiences to financial services. And I think I can give a pretty specific example of the kind of thing you're pointing at is that I have a paper that just recently came out in the Journal of Finance about how fintech lenders brought automation to small business lending. And we show that this reduced discrimination against Black-owned firms, which was kind of caused by the conventional method of loan processing, where human loan officers and their biases played an important role. So, essentially by automating the lending processing, you can actually remove, potentially biased humans from the equation and end up with a sort of more equitable process. So that's, I think, one example of the benefits of fintech, of
Yeah, I think that's a great example because that was something I was thinking as well. Like, how does automation, play a role in this? And it looks like it can have positive effects. And entrepreneurial activities, like at the individual level or firm level, it's an important part for the innovation process. So maybe we can also start talking a little bit about the role of governments. I mean, governments can support innovation through R&D grants or subsidies or other types of tax policies, etc. As we talked in the beginning, innovation is a risky element. It's a risky investment. Maybe we can start thinking about what do economists think about the effects of the government intervention to innovation? Are there different opinions about that? Are there pros or cons? And why does government intervene?
well, there's a huge amount in that question that maybe we can break it into chunks. But I think governments almost universally encourage innovation. And the reason is that they know innovation is the source of economic growth and national security. They intervene in many ways. And actually, in a recent review article I wrote that's called Government Intervention in Innovation, I categorize this systematically. So some programs share risk or cost directly, for example, by guaranteeing debt or offering grants, and others, increase productivity by, for example, investing in human capital or physical infrastructure. So I organize it in that article government intervention and innovation into arenas, agendas, and instruments. So three kind of dimensions. The arenas are firms, financial intermediaries, universities, and government laboratories. The key agendas are entrepreneurship, defense, climate, health, and education. And the instruments fall into three categories: supply push, demand pull, and legal. So supply push instruments affect production decisions, things like subsidies and tax benefits for innovation investment, as well as direct public provision, like through government laboratories. Demand pull instruments concern consumption. So they are things like government procurement, for example, the Department of Defense buying a new type of aircraft engine. They include prizes, and they include price measures like pollution taxes, which might encourage innovation in pollution abatement. And legal instruments include intellectual property protection, like patents, antitrust, bankruptcy, and non-compete laws. So all of these have very important kind of standard setting implications for innovation. They kind of create, let's say, the boxing ring that enables entrepreneurs and innovators to bring new technologies to the market. So the tools of economics and finance, which are, I think designed like theoretically to predict causal relationships and then test them rigorously in contexts where we don't have randomized experiments, are really well positioned to evaluate innovation policies and sort of guide governments to pursue the most impactful and efficient programs. And so that's what some of my research has worked on.
So, and also, I mean, we can also think about the like the when you think about the government push, it also depends on maybe what policy they prioritize the most. For example, if you look at the Second World War period, we see, for example, like the Manhattan Project, where there was a push by the government and they produced the first nuclear bomb. It then led to more technological advancements, but with a huge cost. So in that sense, I mean, the government push, like, it can also change the direction of technology, right? So what do you think about that aspect?
You're absolutely right that government push, as well as demand pull instruments, change the direction of technology. I think from a broad view of kind of the literature is that subsidies in the form of grants or tax benefits directed at R&D performing firms appear to be quite effective at motivating real investment and real innovation. And as one example of that, I show in a paper about R&D grants at the Department of Energy that they have large effects on positive effects on measures of innovation, financial and commercial success. And to your point about kind of pushing innovation in a particular direction, that they are more useful for the more novel, clean subsectors of energy like geothermal energy versus the more traditional sectors like oil and gas. And so in that way, kind of the government program can actually sort of encourage innovation in these sectors where the government believes there are sort of larger positive spillovers or benefits to the economy from this work. So in clean technology, for example, versus traditional technology. Now, in contrast, I think there needs to be more work here, but the evidence suggests that subsidies to financial intermediaries like investors in startups does not seem as promising. And I have a project on that as well that looks specifically at state level angel investor tax credits. So these are very widely used subsidies to try to get wealthy individuals to invest in high growth companies. And we show that although they're widely taken up, they actually really have no effect on new high growth venture creation or job creation in the locality. And we think that's partly that it's just very difficult to kind of move the investment decisions of these investors using this sort of incremental intensive margin subsidy. Now, and then at the university level, we think there's tremendous benefit from university investment, both to build an educated innovation workforce, that is to supply the most crucial input to R&D, which is scientists who are searching for new ideas, and to invest in kind of the open-ended research. Remember that first part of the innovation life cycle, the basic research that really begins in the university lab and spills over to the rest of the economy, that those ideas can be sort of infinitely used by other economic actors. And then on the, to move to my sort of last arena, which is direct government spending and in laboratories and in procurement, there's some perspectives and there's not rigorous evidence here, but there's some evidence that it is most useful when done in these sort of large scale moonshot type programs that aim to kind of coordinate resources and different stakeholders to pursue kind of a common really high risk, high reward outcome. And that often has sort of serendipitous effects in other areas that they sort of don't necessarily expect. But I think like the big picture is that the benefits of innovation are so large, despite the government's information problems and despite the challenges of trying to figure out like what direction should we want to push innovation. I don't think there's any reason for sort of shying away from targeted projects. That the return to investment innovation is large enough that almost any investment in the performance of innovation itself, which is different, as I mentioned, from investing in innovation as a financial intermediary, is worth.
Thank you. And also, I mean, you're also very much involved in, policy suggestions, and you write and you give and you do presentations. So for example, like if people go to your website, they would see a section where you have press and policy. I mean, maybe you can talk about the problems that you see right now and maybe some of the policy pieces or suggestions, like suggestion pieces that you gave to the government. And how is it like from theory to practice, and how are you perceived and how are your suggestions perceived by them, by the policymakers? Maybe you can give us some
Yeah.
hints about
Well,
that.
so, I really value having a relationship with policy as a really in a with bilateral kind of or bidirectional benefits, I should say, where I really think my research is worth doing if I can have an impact on policy and practice. And in turn, when I engage with practitioners and policymakers, I often get ideas for new projects or new data sets. And I think, we are not, as economists, like we are not basic scientists, we are not physicists in the lab, like just searching for fundamental new relationships in the universe. Like our research topics are fundamentally grounded in ever changing human behavior with like all of its flaws and all of its frictions. It's not as much as we would hope it to be. I don't think it's really a hard science. I think it's very difficult to sort of do really good, impactful work without understanding kind of what's happening on the ground in whatever industry or domain that you're studying. And, as you mentioned the military R&D, we know, that going back to ancient times, military defense rationales have been a really important source of kind of government coordinated investment in R&D and of innovations that ultimately get deployed in the private sector. As to highlight this sort of, as I said, bidirectional interaction, I presented the paper that I mentioned about the Department of Energy's grants to startups at Stanford a long time ago. And PhD student who was an Air Force officer at Stanford who saw my presentation, and he had been actually tasked by the Air Force to kind of reform the same program there that I was studying at the Department of Energy, which is called the SBIR program, or Small Business Innovation Research Program, which Congress requires that all government agencies that do any sort of R. We talked about like what kind of implications my results could have for his program. And in particular, one of my findings was that when firms win grants many times, and they're kind of older firms that kind of specialize in winning these grants, often are located like in the Washington, D.C. area. They're not really kind of startups looking to commercialize in the private sector. Then these grants really don't have any effect on measures of patenting or technology commercialization. And so he actually brought those ideas to bear in reforming the program at the Air Force. And he also had totally independently an idea that was really interesting, which is to include what is called open calls for innovation in his program. So rather than ask the private sector to come up with like a very specific widget or technology. So they would say, like, the traditional way of this program would go is say, like, hey, firms, why don't you apply to produce a new kind of silver silver paint for our airplanes because we need like better paint for our airplanes. And so you would get a bunch of small firms who would sort of apply to get this grant to pursue this particular technology. So what my, ultimate co-author, his name is Jason Rathje, did is he said, why don't we flip this around? We don't really know what ideas we need in the Air Force. We know that the private sector and Silicon Valley is doing all this frontier innovation in areas we care about, like ranging from quantum computing to robotics, AI, and we know that this sort of that these domains exist. We don't really know how it can be applicable to the Air Force. So why don't we let the private firms come to us with ideas? So this new open call allowed firms to present any idea that they thought would be useful to the Air Force that they were also trying to develop for commercial markets. And so I ended up actually working with Jason and John Van Reenen to write a paper about that dimension of the reform, to look at the implication of what we call sort of opening up kind of R&D procurement, issuing these open calls, which it turns out is actually widely used in different parts of the US government, at private firms, and other countries. I think actually we cite the UK, where you and John are, has an open call R&D program. And so we actually show that these open calls had much larger benefits to military and commercial innovation than the conventional top-down program, which was run simultaneously.
Thank you very much for the explanation. And also, maybe we can ask the final question about research. Can you tell us about, what you're currently working on, and what are the gaps in the literature that you would recommend to PhD students or early career academics?
I'm currently working on several projects, some in private equity, some around small business and entrepreneurship. And to, maybe to return to something we talked about at the beginning, which is thinking about this tension of trying to protect retail investors in investment markets. One project has to do with evaluating the way that the US Securities and Exchange Commission seeks to protect investors from fraud in private equity and venture capital. And traditionally, to avoid going through the disclosure process that like you have to do for an IPO, VC managers had to raise funds like from to find those limited partners that we talked about only through their personal networks. And in 2013, a new policy allowed them to publicly advertise that they're fundraising. And in work I'm doing with Ting Shu, who is at Toronto, Rotman, and Dean Parker, who's a PhD student at NYU, we show that this policy actually benefits managers, VC fund managers who are relatively less well networked, like women and minorities and managers from people who didn't go to an elite school. But we also document attention, which is that if you're fundraising at arm's length, remember, so like from far away where you don't personally know your counterparty, then you need a strong track record because there's this information asymmetry. It's really hard to evaluate quality. So people who have track records typically build networks while they're doing this. So what we show is that in practice, this policy didn't achieve its goal of allowing new and traditionally underrepresented managers to enter the industry. So that's one project. I think, to your question, the second part of your question about like what are areas to work on, there's so many great topics to work on. What I work on very broadly is private capital markets and their impact on the economy. And I think there is much to be done on this from many perspectives. In between 2012 and 2022, the global growth in private capital was more than 2.5 times larger the growth in public equity and fixed income assets. There is almost $15 trillion today or more in private capital funds. And I think especially in finance, there has been this sort of lamppost effect of studying public companies. And then in the context of innovation economics, of studying patent data. And I think broadly, we can get a lot out of new data that's increasingly becoming available from textual sources and from private firms to study the innovation ecosystem more broadly.
These sound very interesting, actually. I'm looking forward to reading them. I also ask a few cheesy questions to our guests. And one of the things that I want to ask, for example, is if you had a magic wand, what would you change in academia? Is there something that you would I mean, that you find negative and you want to change, or I don't know, make something even more positive?
Well, I guess if I have to pick something, I think the way the refereeing process works is sort of not ideal, especially amid rising competitiveness of the industry, where we sort of have a lot more people doing a lot more work with the same number of sort of top journals that count for tenure. And this has sort of increasingly led to incentives, particularly for junior scholars, to do less ambitious work that is sort of bulletproof from a causality or identification perspective rather than being important. I think more
Mm.
important, I think like it would be great if we could pay more attention to important descriptive work. And that, ideally people beyond like Raj Chetty and his team of 100 could do, could be part of that. I think there's an easy way to do this, which is really for the top journals to kind of carve out space designed, for big questions that are addressed using, high quality data rather than just like super niche data where you have some sort of natural experiment to attack some like tiny little question.
Yeah, I think that's important. I remember like with Philippe Aguillon, we were talking about this, and then that was kind of, and Darren Asamoah as well. Like, would you choose causality? Like, because there is a huge obsession right now for causality and for niche questions, and you have to have novel, data sets, etc. But at the same time, we sometimes forego like the important questions or bigger questions or the bigger picture. So I think that's very important. I agree. If you, for example, like, could not be, if I mean, you said you're very happy with your with your job, but if you could not be a finance professor in a parallel universe, what would you like to be?
I guess I'd settle for being an economics professor.
Okay, okay, no, you can't be in academia then.
Okay. I'd most want to work, I think, in venture capital. It has some parallels to academia in that VCs get to dive deeply into many projects that, which is the different startups they invest in, and they get to be continuously learning. They get to work with different teams, which is sort of like our co-author groups, but also have a home base of colleagues at their firm, as we have our departments. And finally, they get to control their own time and what they work on most days, and don't necessarily have to put in long hours when they don't want to, which I really value.
Hmm. And maybe one final question, which I think will be helpful for many of us, probably. For example, because I mean, research isn't a smooth process, so there's so many times you have problems or challenges, etc. So, what was the biggest challenge in your role or in a project now or in the past, and how did you tackle this? And maybe that could be a like piece of advice for these, for people in their early academic career.
The biggest challenge for me by far is how to allocate time, which is our most precious resource. I think the particular options and demands on our time vary over kind of our career life cycle. I think, early on when I was a junior and before I had kids, I allocated too much time to projects that were not high quality, but which were sort of left over from my PhD days and that I refused to let die. I was definitely a victim of the, sunk cost fallacy. So, now I'm at a different place in life and I have to decide every day how much time to spend with my little kids. I have a 1 year old and a 5 year old versus my work. And then of course all of the other things that one might want to do in one's life. And I love, both of those things. And so it's really hard to find a balance that works. And I think I try and I do, but it's not always easy day to day.
I agree. And by itself, I mean, since we work on like several different projects sometimes, I also fall into that kind of trap where it's like there is no time. I mean, and also in terms of like mind space as well, sometimes you don't have any mind space left for an additional project, for an additional work, etc. So I think it's important to create some kind of mind space, and at the same time, in terms of time allocation, maybe we can do it better. And especially like is at the beginning, you also said like you chunk things into like smaller pieces, just take smaller steps, and I think that's very important, like creating that consistency. I think it's been a great talk, Sabrina. Thank you very much for attending our podcast. And I hope also our audience or listeners enjoyed the talk. If they have any questions or any comments, they can email us at through lscpodcast@gmail.com, or they can reach us out from X at poid_cast. And see you in the next episode. See you later.
Bye. Thanks very much.